Something extraordinary is happening right now in the precious metals market, and if you're not paying attention, you're going to miss one of the most significant wealth transfers in modern history. I'm watching retirees, people who've spent their entire lives building nest eggs, who've weathered every market storm from the dot-com crash to 2008, suddenly making moves they've never made before. And when I dug into the data, what I found shocked me. Let me paint you a picture. 3 weeks ago, I was reviewing the latest positioning reports from the CFTC, and I noticed something unusual. Retail investors over the age of 55 are accumulating physical gold at rates we haven't seen since the 2011 peak. But here's what's different this time. They're not buying because gold is going up. They're buying because they've finally figured out what the smart money knew all along. You see, there's a reason why central banks added 1,037 metric tons of gold to their reserves in 2023 alone. There's a reason why Poland just moved 100 tons of gold back from the Bank of England to Warsaw. There's a reason why China's been quietly accumulating gold every single month for the past 18 months straight, never missing a beat. They know something. And now, everyday retirees are starting to connect the dots. Let me take you back to a conversation I had last month with a 67-year-old former engineer named Robert. Spent 40 years at Boeing, did everything right, maxed out his 401k, diversified into bonds, kept a healthy cash position. Classic retirement playbook. But Robert told me something that stopped me in my tracks. He said, "I just realized my entire retirement is denominated in promises. Promises from the government that Social Security will be there. Promises from corporations that their bonds will pay. Promises from the Federal Reserve that the dollar will hold its value. And for the first time in my life, I don't trust those promises anymore." Robert isn't alone. And he's not some conspiracy theorist or doomsday prepper. He's a rational, educated person who's simply looking at the same data the institutions have been analyzing for years. And what that data shows is deeply concerning. Right now, the United States national debt is sitting at $36 trillion. Let that number sink in for a moment. $36 trillion. That's $36,000. To put that in perspective, if you spent $1 million every single day, it would take you over 98,000 years to spend that much money. And we're adding to it at a rate of roughly $1 trillion every 100 days. The interest payments alone on that debt now exceed $1 trillion annually. More than we spend on defense, more than we spend on Medicare. But here's where it gets really interesting. The Federal Reserve's balance sheet, which was under $1 trillion before 2008, exploded to nearly $9 trillion during the pandemic. They've brought it down somewhat through quantitative tightening, but we're still sitting at levels that would have been unimaginable just 15 years ago. And every economist worth their salt knows what happens next. When the next crisis hits, and it will hit, that balance sheet is going right back up. More money printing, more currency debasement, more inflation eating away at purchasing power. Now, I want you to think about what this means if you're sitting on a retirement account worth $500,000 or $1 million or $2 million. You've spent decades accumulating that wealth. You've made sacrifices. You've delayed gratification. You've done everything the financial advisors told you to do. But that entire nest egg is denominated in dollars, and those dollars are being systematically devalued by policies that are completely outside your control. This is what Robert figured out. This is what thousands of retirees are figuring out right now. And this is why they're moving to gold. Let me show you something fascinating that's happening in the physical gold market right now. The premiums on American Gold Eagles, the most popular gold coin in the United States, have been elevated for months. We're talking about premiums of 5% to 8% over spot price, sometimes higher. That tells you something critical. Demand for physical gold is outstripping supply. People aren't just buying paper gold or gold ETFs. They want the real thing. They want to hold it. They want it outside the banking system. And it's not just retail investors. Look at what's happening at the institutional level. The World Gold Council reported that central bank gold purchases in 2022 were the highest since 1967. Let me repeat that, the highest in 56 years. And 2023 was almost as strong. These aren't small countries hedging against regional instability. We're talking about major central banks, China, Russia, India, Turkey, Poland, all accumulating gold at unprecedented rates. Why? Because they're watching the same debt spiral we are. They're watching the weaponization of the dollar through sanctions. They're watching the BRICS nations actively work to create alternative payment systems that bypass the dollar entirely. They're watching the slow-motion collapse of dollar hegemony, and they're positioning themselves for what comes next. Here's a story that didn't get nearly enough attention. In 2023, the BRICS nations, Brazil, Russia, India, China, and South Africa, announced they were exploring the creation of a new currency backed by a basket of commodities, with gold playing a central role. Then they invited 6 new countries to join: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates. Think about that for a moment. Saudi Arabia, the country whose oil has been priced exclusively in dollars since 1974, the foundation of the petrodollar system, is now exploring alternatives. This isn't some fringe movement. This is roughly 45% of the world's population and a growing share of global GDP actively working to reduce dependence on the US dollar. And every step they take in that direction puts more pressure on dollar demand, which means more pressure on dollar value, which means more erosion of your purchasing power. Now, I know what some of you are thinking. Gold doesn't pay interest. Gold doesn't pay dividends. Why would I want an asset that just sits there? And that's a fair question. It's the question I hear from traditional financial advisors all the time. But it's the wrong question. The right question is, what's the point of earning 4% interest if inflation is running at 6% or 8% or 10%? You're not getting ahead. You're falling behind in real terms. Gold doesn't need to pay interest because gold is insurance. It's insurance against currency debasement. It's insurance against government mismanagement. It's insurance against the kind of monetary experiments we've been running for the past 15 years. And right now, that insurance is looking more valuable than ever. Let me give you a concrete example. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, an ounce of gold was worth $35. Today, it's trading around $2,050. That's a 7,471% increase. But here's the more important number. In 1971, the median home price in the United States was $25,200. Today, it's around $420,000. That's a 1,567% increase. Gold has outpaced housing by nearly 5 to 1 over that period. It's outpaced the stock market when you adjust for real inflation. It's outpaced virtually every asset class when measured against the debasement of the currency. And we're at an inflection point right now where that trend is about to accelerate. Here's why. The Federal Reserve is trapped. They can't raise interest rates high enough to truly fight inflation without crashing the economy and making the debt unsustainable. The interest payments alone would consume the entire federal budget. So what are they going to do? They're going to do what every government in history has done when faced with unsustainable debt. They're going to inflate it away. They're going to print more money, debase the currency, and hope they can manage the transition without triggering a complete loss of confidence. But here's the problem with that strategy. It only works if people don't catch on. It only works if the average person doesn't understand what's happening and doesn't take steps to protect themselves. And right now, people are catching on. Retirees are catching on. The smart money has been positioned for years, and now the retail wave is starting to build. I'm seeing it in the data. I'm seeing it in the premiums on physical gold. I'm seeing it in the wait times at major dealers. I'm seeing it in the conversations I'm having with people who've never owned an ounce of gold in their lives, suddenly asking how to get exposure. Quick aside here, if you're sitting on $100,000 or more in retirement accounts and you're thinking about this, I put together a comprehensive guide on how gold IRAs work. It's completely free. Link is in the description. It walks through exactly how you can get physical gold into your retirement account without triggering tax penalties, how the custodian system works, what the fees look like, all of it. Worth checking out if this is relevant to your situation. No pressure, just information. Anyway, let me show you what's happening in the technical picture right now because it's absolutely fascinating. Gold broke out of a multi-year consolidation pattern in late 2023, pushed through $2,100, then $2,200, and recently touched all-time highs above $2,650. But here's what's interesting. It's doing this while the dollar has been relatively strong and while real interest rates have been positive. Historically, gold struggles in that environment. The fact that it's making new highs anyway tells you something about the underlying demand. And when you look at the futures market, the picture gets even more interesting. The commercial hedgers, the smart money, the producers and institutions who actually deal in physical gold, have been reducing their short positions. That's significant. These are the players who are usually short gold as a hedge against their physical holdings. When they reduce those shorts, it means they're less confident that prices are going to fall. It means they're repositioning for higher prices ahead. Meanwhile, the large speculators, the hedge funds and momentum traders, are not excessively long. We're not seeing the kind of frothy, over-leveraged positioning that typically marks a top. There's room for this rally to run much further before we hit those warning signs. But the real story isn't in the futures market. It's in the physical market. It's in the fact that the Shanghai Gold Exchange is consistently trading at a premium to London and New York. It's in the fact that gold is flowing from west to east at unprecedented rates. It's in the fact that the COMEX registered gold, the gold that's actually available for delivery, has been declining as a percentage of total open interest. Let me explain why that matters. The COMEX is where gold futures are traded in the United States. Most of those contracts are settled in cash, not physical delivery. But some percentage of traders do stand for delivery. They actually want the physical gold. And the amount of gold available to satisfy those delivery requests has been shrinking relative to the number of contracts outstanding. That's a setup for a squeeze. That's a setup for a situation where the paper price and the physical price start to diverge, where premiums explode, where people who thought they had gold exposure through paper contracts suddenly realize they're holding IOUs that might not be redeemable at anywhere near the current spot price. This happened in silver in 2021. The premium on physical silver coins went to 50% or more over spot price. You couldn't find silver anywhere. Dealers were sold out, mints were rationing production, and the spot price barely moved because the paper market was still functioning. But if you wanted actual physical silver, you were paying massive premiums. Now imagine that happening in gold. Imagine a scenario where the spot price is $2,700. But if you actually want to buy physical gold, you're paying $3,200 or $3,500 because there's a shortage. That's not some far-fetched scenario. That's a real possibility given the current market structure and the flow of physical gold from west to east. And here's the thing that keeps me up at night. If we do see a crisis of confidence in the dollar, if we see a major geopolitical event, or a debt crisis, or a banking crisis, or any number of potential triggers, the demand for physical gold is going to explode. And there's simply not enough physical gold available to satisfy that demand at current prices. The price would have to rise dramatically to ration the available supply. Think about what happened in 2008. Gold went from $800 to $1,900 in less than 3 years. That was a 137% gain. And that was in an environment where the dollar was still the unquestioned global reserve currency, where central banks weren't accumulating gold at anywhere near current rates, where the debt-to-GDP ratio was 40% lower than it is today. What happens in the next crisis when all those conditions are worse? Some analysts are calling for $3,000 gold. Some are calling for $5,000. Some are calling for $10,000 or higher. I don't know where the top is. Nobody does. But I do know that the setup right now is more bullish than anything we've seen in over a decade. And I know that the retirees who are moving into gold right now are making a rational decision based on the fundamentals. Let me tell you about another person I spoke with recently. Her name is Margaret. She's 71, retired teacher from Ohio. She told me she spent her whole life trusting the system. Trusted her pension, trusted Social Security, trusted that the government would be responsible with the currency. But then she started noticing things. She noticed that her grocery bill kept going up even though the official inflation numbers said everything was fine. She noticed that her fixed income wasn't stretching as far as it used to. She noticed that the politicians kept promising fiscal responsibility while the debt kept exploding. So Margaret did something she'd never done before. She took 20% of her IRA and moved it into physical gold. Not gold stocks, not a gold ETF. Physical gold in a secure vault with her name on it. And she told me, I sleep better at night now. I know that no matter what happens to the dollar, no matter what happens to the stock market, no matter what happens to the banking system, I have something real. Something that's been money for 5,000 years. Something that can't be printed or debased or inflated away. That's the psychology shift I'm seeing. That's what's driving this move into gold. It's not greed. It's not speculation. It's prudence. It's people who've worked their entire lives to build wealth finally realizing that wealth needs to be protected, not just accumulated. And the timing couldn't be more critical. We're entering a period where the risks are asymmetric. The downside risk of not owning gold, of being 100% exposed to dollar-denominated assets in an environment of massive money printing and currency debasement, is enormous. The downside risk of owning gold is that it might not go up as much as you hoped, or it might consolidate for a while. But it's not going to zero. It's not going to disappear. It's not going to be inflated away. Look at what's happening in the bond market right now. The 10-year Treasury yield has been volatile, but the real story is in the long end of the curve. The 30-year Treasury is telling you that bond investors are demanding higher compensation for the risk of holding long-dated dollar-denominated debt. They're looking at the same fiscal trajectory we are, and they're saying, I need to be paid more to take that risk. But here's the problem. If yields keep rising, the interest expense on the national debt becomes even more unsustainable. We're already spending over $1 trillion a year on interest. If the average interest rate on the debt goes from 3% to 4%, that's another $360 billion in annual interest expense. Where does that money come from? It comes from more borrowing, which means more debt, which means higher interest expense, which means more borrowing. It's a death spiral. The only way out is for the Federal Reserve to step in and buy bonds, to monetize the debt. And when they do that, when they fire up the printing press again, gold is going to explode. Because at that point, it becomes undeniable that the currency is being debased. It becomes undeniable that the purchasing power of the dollar is being systematically destroyed. And everyone who's been sitting on the sidelines is going to rush for the exits. I want you to think about the historical parallels here. In the 1970s, we had a similar setup. We had massive government spending from the Vietnam War and the Great Society programs. We had a Federal Reserve that was too accommodative. We had rising inflation that the government kept insisting was transitory. And we had a gold price that went from $35 in 1971 to $850 in 1980. That's a 2,329% gain in less than a decade. Now, I'm not saying we're going to see that exact same trajectory. The circumstances are different. But the underlying dynamics are remarkably similar. We have massive government spending. We have a Federal Reserve that's been extraordinarily accommodative. We have inflation that's been running hot despite official claims that it's under control. And we have a gold price that's breaking out to new all-time highs. The difference is that this time, the starting point for debt is much higher. The starting point for the Fed's balance sheet is much higher. The starting point for global dollar skepticism is much higher. All of those factors suggest that when gold really starts to move, it could move even more dramatically than it did in the 1970s. And here's something else to consider. In the 1970s, gold ownership had only been legal for Americans since 1974. The market was relatively small. Today, the gold market is much larger and much more liquid. But the amount of physical gold available for investment is still tiny compared to the total amount of financial assets in the world. Total above-ground gold stocks are worth maybe $15 trillion. Total global financial assets are over $400 trillion. If even a small percentage of that $400 trillion decides to move into gold as a safe haven, the price impact would be enormous. This is what the smart money understands. This is what central banks understand. This is what retirees are starting to understand. The question is, are you going to wait until everyone else figures it out, or are you going to position yourself now while there's still time? Let me be clear about something. I'm not saying you should put 100% of your wealth into gold. That would be foolish. Diversification is still important. But I am saying that if you have zero exposure to gold right now, you're taking a massive risk. You're betting that the government is going to get its fiscal house in order. You're betting that the Federal Reserve is going to successfully navigate an impossible situation. You're betting that the dollar is going to maintain its purchasing power despite all the evidence to the contrary. Those are bad bets. And the retirees who are moving into gold right now understand that. They're not trying to get rich. They're trying to preserve what they've already built. They're trying to make sure that the wealth they've accumulated over a lifetime doesn't evaporate in a currency crisis or an inflation spiral. Think about the alternative. If you're 100% in stocks and bonds and cash, and we see a major devaluation of the dollar, what happens? Your stocks might go up in nominal terms, but they'll go down in real terms. Your bonds will get crushed. Your cash will lose purchasing power. You'll watch your retirement savings erode in real time, and there won't be anything you can do about it. But if you have 10% or 20% or 30% in gold, you have a hedge. You have something that's going to move in the opposite direction. You have something that's going to preserve your purchasing power, even as the currency loses value. That's not speculation. That's insurance. That's prudence. And right now, that insurance is still relatively cheap. Gold at $2,750 might seem expensive if you're comparing it to where it was 5 years ago. But if you're comparing it to where it's going to be 5 years from now, it's going to look like a bargain. Because the forces that are driving gold higher, the debt, the money printing, the loss of confidence in fiat currencies, those forces are accelerating, not decelerating. I want to leave you with one final thought. In every major currency crisis in history, there have been people who saw it coming and positioned themselves accordingly. And there have been people who ignored the warning signs and lost everything. In Weimar Germany, the people who held gold preserved their wealth. The people who held marks saw their savings become worthless. In Zimbabwe, the people who held hard assets survived. The people who held Zimbabwean dollars were wiped out. We're not Zimbabwe. We're not Weimar Germany. But we are running the same playbook. Massive debt, massive money printing, and a government that's unwilling or unable to make the hard choices necessary to fix the problem. And the outcome, while it might take longer to unfold, is going to be the same. The currency is going to lose value. And the people who are prepared are going to preserve their wealth, while everyone else watches theirs evaporate. The retirees who are moving into gold right now understand this. They've lived through enough market cycles to recognize when something fundamental is changing. They've seen enough government promises broken to know that you can't trust the system to protect you. They're taking responsibility for their own financial security, and they're doing it while there's still time. The question is, are you going to join them? Or are you going to wait until it's too late? Until the premiums are 50% over spot? Until you can't find physical gold at any price? Until the crisis is already here and everyone is scrambling for the exits? Because by then it won't be about getting ahead. It'll be about damage control. And the people who position themselves early will be the ones who come out on the other side with their wealth intact. This is your moment. This is your opportunity to make a decision that could define your financial future. The smart money has already moved. The institutions have already positioned themselves. The central banks have already accumulated. And now, retirees across the country are figuring it out and taking action. The only question is, what are you going to do?